Okay, so now we're going to take a look at S corporations in the self-employment tax context. So we'll take a little bit of a deeper look at this. And the reason, I know we don't spend a lot of time on employment taxes typically in these types of courses, because employment taxes are so easy to calculate that a lot of times we think about income taxes because there's so much more complexity there. But we care about self-employment taxes quite a bit at the S corporate level when it comes to S corporations, because this is a major planning opportunity, and this is probably the main reason S corporations are used, because the special allocation benefits and the benefits on transfers of assets would tend to put you in a partnership tax type of entity situation in most instances, and yet S corporations are very, very common. In fact, so interestingly enough, S corporations are actually the most common type of flow-through entity for highly profitable companies. So think about that for a minute. Companies that generate a lot of profits, the more profitable flow-through entities tend to be S corporations. The majority of them are, just statistically. If you have a highly profitable entity, and I believe the cutoff for that was somewhere in the millions of dollars. It may have been $5 million or more. So entities that earn $5 million or more, don't quote me on the cutoff, but there is a cutoff where they've decided highly profitable. And the majority of those entities tend to be S corporations. And so there are a couple of reasons. So first of all, losses, you can't do special allocations with losses in S corporations. So if you have a corporation that's a startup and you're anticipating having significant losses in early years, you tend to want to be a partnership in that case, because then you can allocate those losses to the partners who can benefit the most from them. Like if you have a talent partner and you have a investing partner, the investing partner is going to want to be able to take those losses because the investing partner in the partnership will have the basis to do so. But once your entity is profitable, you don't have those same motivations. And so you're more concerned about planning for the income tax effects of the entity. And that's where the S corporations tend to shine, because there are a couple of important and critical rules relating to payroll taxes and relating to net investment income tax, which is on investment income. So first of all, let's look at payroll taxes and self-employment taxes. So when we say self-employment taxes, what we're talking about is where you have an owner, a shareholder of the S corporation, and they're working inside the business, okay? So if you aren't working inside the business, you wouldn't pay self-employment taxes. But if you are, then you do. So self-employment taxes, shareholders are subject to self-employment tax, or SECA tax, based on the reasonable value of their compensation. And this is similar to the SECA tax treatment for limited partners in a partnership. So limited partners in an LLP get this treatment. And in a C corporation, you get this treatment. So if you think about a C corporation really quickly, C corporations are separate entities. And so they pay a salary to their shareholders that work for them, right? Because if you're a shareholder of a C corporation, you aren't going to just work for free. You work for a salary, and you happen to get dividends from the C corporation when the C corporation does well. So you get paid in two different contexts. You get paid for the wage, for the work you're providing to the business, and you get paid because you own the shares as an investor. And so those are two ways that you get paid. Well, in an S corporation, you don't have that distinction necessarily carved out, because you might be working for the corporation, the S corporation, and since it's a flow-through entity, you just don't worry about paying yourself a salary. And so if you don't pay yourself a salary out of it and all of your money comes from distributions from the S corp, or your distributive share of the S corp, then the way that your self-employment tax is calculated is it's based off the reasonable value of the services you provide. So you're going to pay self-employment tax on the reasonable value of those services, but everything over that amount is not going to be subject to self-employment tax. Now, there's now a net investment income tax regime. So when we're talking about income that drastically exceeds $100,000 a year, so let's say it's $400,000 or $600,000 or $1 million in income a year coming out of this entity, Well, now you care less about self-employment tax because those rates aren't quite as high when you get up over the minimum threshold, which is about $100,000. But what you do care about is the additional Medicare tax, which is 3.9% or 3.8%, I believe. Or even if you aren't subject to the additional Medicare tax, you might be subject to what's called the net investment income tax. So net investment income tax is 3.8% on your investment income. And so the key here and why this is a great planning strategy is that on the payroll tax side, you're subject to tax up to the amount of your reasonable value of your compensation. But if you're considered to be active in the business entity, then you aren't subject to net investment income tax. So repeating that again, your payroll tax side is just on the value of your compensation, the reasonable value of your compensation. You'll pay payroll taxes on that amount. That's your tax base. And then for net investment income tax purposes, you actually don't pay tax as long as you're active in the business. So when they're trying to decide whether net investment income tax applies, the rules were, look, if it's subject to payroll tax, then it's not net investment income tax. And if you're active in the business, then it's not net investment income tax. Those are really the two rules for the net investment income tax. So if you're active in the business, but part of your income isn't subject to payroll tax, which it isn't if it exceeds the reasonable value of the compensation, reasonable value of the services you're providing, then that income is subject to neither payroll tax nor is it subject to the net investment income tax. I actually wrote an article on this phenomenon, on this loophole when that act was first passed. I read it and thought, wow, this is really a poorly written law, because the intention was to capture everything as either payroll taxes or net investment income taxes, but they created this huge loophole by adding the passive-active distinction. And so the term that a lot of people say is, they use the term threading the needle on the loophole. And the idea is that you're basically getting people to be active in the business, or at least meet the minimum requirements for being active, but they're also not providing significant, valuable services to the business, and that way you're basically not getting taxed on by either net investment income or the other. And 3.8% doesn't sound like a tremendous amount, but imagine that on $1 million. What's 3.8% of $1 million? Well, that's $38,000. That's a pretty good, every single year saving $38,000 in taxes is not insignificant by any means. So that's an important, it's an important loophole, and a lot of people are using it for profitable flow-through entities. So there's that. So that's our example, and I think that's all I want to say on self-employment taxes for S-corps and the net investment income tax and how they're used. But this really is one of the main things that's driving a lot of people to utilize S-corps, because there's a lot of problems with them. Remember, we talked about blowing the S election. There's a whole bunch of negative tax consequences that result from that. And so being an S corporation isn't necessarily a great entity type to be, but a lot of businesses still do it because they can save that tax. They can save on SECA. Also, if you're a partnership and you're active in a partnership, you actually will pay self-employment tax on every dollar that the partnership pays out. And so the extent to which it's beneficial to be active in an S-corp, it's the exact opposite in a partnership. You will definitely pay self-employment taxes on everything in a partnership if you're active in the business. If you're inactive in the business, it depends on your status. If you're a limited partner, and there really aren't very many LLPs nowadays, but if you're a limited partner, then you get similar treatment to this. But if you're a limited partner, let's talk about this. What will you be subject to? If you're a limited partner, can you be active in the business? Anybody know the answer to that? No, you can't. In fact, by definition, if you become active in the business as a limited partner, you're no longer a limited partner, you become a general partner. And so you can save by avoiding self-employment tax by being a limited partner, but that means you're definitely passive in the business, which means you are going to be paying net investment income tax on that amount. So limited partners, really your only tax break is going to be the difference between really on the first $100,000 or $250,000 before the net investment income tax kicks in. you'll save some money there, and that's it. And so you'll save some on SECA because you're a limited partner and you don't pay self-employment tax. But once you hit $250,000 in income and up, you're automatically paying net investment income tax. And that's not just the income from the SCorp. So if you have income from other sources, you can be at that amount on $1. So $1 out of your S corporation might be taxed at 3.8% for net investment income tax purposes if you're a limited partnership. But if you're an S corporation and you're active, then you avoid it, right? So there's that. So that's why S corporations are popular for tax purposes for closely held businesses. Now I want to look at allocating income and loss throughout the year with ownership changes. So we talked about before how ownership in an S corporation, everything's done on a pro rata basis. And so if you have ownership changes throughout the year, you have to allocate this income based off the rules. And this functions kind of the way you would expect. So the general rule is since the ownership may vary during the year, income and loss items are allocated on a pro rata basis throughout the year using the following formula. And this is just allocating these items pro rata without regard to when they happen. So that's your general rule. So you might have all of your income in January or all of your income in December, but you're still going to allocate it evenly throughout the year. So you'll take the S-Corp income or loss item, you're going to multiply it by the percentage of shares owned. So if you're a 25% shareholder, you're going to take 25% of the income. And then you're going to multiply it by the percent of the year the shares are owned. So you'll just take the days that you own the shares, divide it by 365. That's the percent of the year that you own the shares. So if you own 25% of the shares for 50% of the year, you're going to have 12.5% of the income item. So that's the way that works. It's pretty straightforward. And I think this is intuitive that it would function this way. And then this is the amount of the item to be reported, and that'll get reported on a K1 and sent to that particular owner. Even if they only owned it for one day, they're still going to get some of the income. Now you can do what's called a short year election, so you can do this slightly differently. Instead of using the pro rata system, which is the default, you can do a short year election. And this happens, so if you think about S corporations, let's talk about why we do this. An S corporation is a flow-through entity. They aren't, even though the income is flowing through pro rata throughout the year under the default rule, that may not be what's really going on with the entity. So let's suppose you have an entity that makes all of its money in December of the year. So for whatever reason, maybe it's like it's a gift wrap company. And so they make a little bit of money from birthdays, but man, Christmas is a big season for them. So they make a whole bunch of money in December. And let's suppose somebody trades or sells shares in that entity in the middle of the year, in the summer. Now, the entities earn basically no income. Maybe the income is just offsetting its expenses all year, and then every December it makes a huge bunch. So allocating, in that instance, half of the income to that person who held the shares when the company wasn't earning any money just wouldn't be very fair. And it's problematic because, remember, you have phantom income. The income going out doesn't necessarily match the cash that's being paid out. And if you had no income, or you're basically break even for 6 months, this shareholder who sold the share halfway through the year definitely didn't get the benefit of that year-end bump. And so if that's the case, that's an instance where, out of fairness, you would probably want to do a short year election. And the way is, this is where shareholders' interests are completely terminated. So you can't do this if somebody just sells some of their shares. They have to sell all of them. The corporation may calculate a short year end where the year is treated as 2 taxable years, and the items are allocated based on the actual income during the periods where the stock is held. So you essentially close the books and figure out all of your taxable items for the first 6 months of the year in that instance and allocate it to everyone accordingly. And then you calculate everything for the next 6 months and allocate it to everyone accordingly, and that's how you do it. People who held the shares for both years are going to get both 6 months of allocations to them, and the person who traded the shares is then going to be treated more fairly. So the person who sold the shares and didn't get that huge income at the end of the year is then going to have a K1 that shows virtually no income for the year, because that was correct. And then the other shareholder who held the shares while all that income came in and got all that cash, at least potentially if they distributed it, then that shareholder is going to be allocated the income. So that's appropriate in that particular setting. But once again, the general rule is just pro rata over the year. So let's look at a quick example. It's a simple example, but you basically have two items in this. A B company, an S corporation with two equal shareholders, Alice and Bella, has $100,000 of income from operations, and we're going to presume that accrued evenly each day of the tax year. So basically every day they earned about the same. And a $20,000 long-term capital gain for the year from a sale of property which occurred in October. So we've got two things. We've got the $100,000 over the year that happens equally, and then you have the one-time $20,000 long-term capital gain that happened in October. Now we're going to assume that Bella sells her shares to Newman on April 1st of the tax year. So April 1st, it's right at the beginning of the second quarter. So we've gotten through 25% of the tax year. And the question is, how much income from operations and capital gain is allocated to Bella under the general rule? Now note, we have separately stated items in S corporations. So since this is an S corporation, we state our items separately. We're going to calculate each item separately. So first, let's look at the income from operations. Bella held the shares for 25% of the year, so how much of the $100,000 should Bella be allocated? It's 25%, right? So it'll be $25,000? Does that sound right? Great. So we get $25,000 of income allocated to Bella. And that's actually correct, right? Because that's actually the income that was earned. If they did a close of the books, that income would go to Bella anyway. So there's really no difference depending on the method in terms of that income. And then we've got the other part, which is the $20,000 long-term capital gain. How do we allocate that? Under the default rule. It's pro rata, right? So we're going to have to go 25% of the $20,000 is going to be allocated to Bella. So how much is 25% of 20,000? 1/4 of 20? It's $5,000. Anybody have a calculator? I think it's 5. So we have a $5,000 long-term capital gain that's allocated to Bella under the general rule. So Bella's going to get the 25 income from operations, 5,000 in capital gains. Okay? Is there anything wrong with that? Or is that fair for Bella to be allocated that 5,000 capital gain? What do you think? When did the capital gain happen? It happened in October. So Bella sold her shares in April. So that happened after she'd already sold her shares. So who got the benefit of that $20,000 long-term capital gain? At least the part that she owned. The new owner, right? Newman. And actually, when I said 25,000 is allocated, it's two equal shareholders, so I should have multiplied it by 50%. So she actually got half of that 25 that accrued over the year. So, but on the long-term capital gain, she's going to get half of the 5,000 that accrued in the first quarter. So she'd actually get 2,500 of it. So in that instance, Newman's the one who gets the benefit of this long-term capital gain. The property was sold. The asset, the money came in from selling that property when Newman was a shareholder. And so under the general rule, you're actually giving Bella some of that gain. She's getting 2,500 of it. Newman's getting 7,500 of it. And she really didn't get any benefit from it. So it's kind of unfair using the general rule in this context because you have income that's not happening evenly over the year. That's really the case. Anytime you have income that's uneven over the year, if you use the general rule, it tends to create things that aren't fair. So what if they make a short year election? Can they make a short year election, first of all? What are the requirements for making a short year election? You have to have a complete disposition of your shares. A party needs to be completely disposing of the shares. Did Bella sell all of her shares To Newman? Yeah, so I say Bella sells her shares, so that's presumably all of them. So if she sells all of her shares, then we can do a short year election in this case. So what if they make a short year election? How are you going to allocate? So we'll go back to our income, $100,000 of income from operations that accrued evenly each day. So in the first quarter, how much income accrued? It was $25,000, like we talked about before. And she owned half, so she's going to get $12,500 of that. So that's how you, if you do the short year election. What about the capital gain? When did that happen? Did that happen in the first quarter? No, it happened in October. So if the capital gain happens in October, then that's not going to be attributable to Bella. When you do the short year election, she gets her $12,500 in allocated income, and then the remainder is all going to go to Newman and Alice, the original owner. So that's how that'll work out. Then the question is, does your answer change if only 10% of the income happened by the end of March, right? So as of April 1st, if only 10% of the income happened, how does our answer change? So now, instead of a fourth of the income happening in a fourth of the year, only 10% is happening. So what's 10% of 100,000? 10,000. So if 10,000 happens by March, we have 10,000 in income, and it's split between Alice and Bella, the shareholders, for those first 3 months. Well, in that case, then yeah, it does change our answer, because instead of allocating 25 two ways, we're allocating 10 two ways. So now, in that case, Bella, if they do the close the books election, is just going to get 5,000 in income, the half of the 10% that was earned, and then the other 90,000 is going to be allocated between Alice and Newman. And the long-term capital gain will also be allocated between Alice and Newman. So the difference can be quite substantial depending on when income items happen, and so this election can be important for shareholders that are selling their shares. Yeah.
10,000 isn't divided by Alice and Bella, so it just.
It is.
Oh,
it is. Okay. Yeah. So the Alice and Bella would share that 10% that happens in the first quarter,
and then the
10,000. So
would be Bella and Newman.
Alice and Newman, yes.
Yeah.
Yep, that's correct.
Okay.
Yeah. So once again, going back, the first quarter you basically have 10% of the income, which is 10,000. There's two partners, or not two partners, two shareholders. And so the two shareholders that are equal owners would split it. So in that instance, Bella would just get 5,000 of that income, and that would be it. The rest of the the other 95,000 plus the 20 is all going to be split between Alice and Newman. That's how we work this problem. So we've got some transitional rules between C corporations and S corporations that we're going to discuss a little bit more in depth. Now, we can only get so far into these because understanding earnings and profits is an entire complicated concept within C corporations. So we aren't going to spend much time on this, but I do want to at least highlight some of the rules when you're going between C corps and S corps. So C corps to S corp, this and what's called accumulated earnings and profits, that becomes an issue. If the S corp was a C corp and had an E&P balance at the time of its S election, which we call accumulated earnings and profits, distributions from accumulated earnings and profits are taxed as dividends. Now this is pretty complicated, this tax calculation, but it's important to be aware of it. So distributions from accumulated earnings and profits are taxed as dividends. What that means is that your distributions will have a dividend tax associated with them until that accumulated earnings and profits is spent. So if you came in with $100,000 in accumulated earnings and profits, the first $100,000 in distributions made to your shareholders, normally distributions only reduce your basis, but in this case you're actually going to be taxed on them as a dividend. Okay, so that's the rule there. It is a little bit more complicated than that, so I don't want to minimize it, but it's just beyond the scope to go into the actual calculation. But I just want you to be aware that this is how an S corporation will act like a C corporation until the accumulated earnings and profits are spent, are used up. And the reason for that is if this were a C corporation and it has earnings and profits, those earnings and profits would be taxed as a dividend. So they wanted to prevent people from organizing as S corporation or filing S elections just to avoid dividend tax. You're not going to avoid it. Now, what you will avoid is when you have earnings within the S corporation, you aren't going to be subject to double layer of tax, but you do need to be taxed on those earnings that happened in the C corporation that were never taxed as a dividend. So that accumulated earnings and profits, whenever you make distributions, it's going to eat away at that, and you're going to have a separate dividend tax associated with it. Normally you wouldn't. Normally you would just reduce your basis, similar to a partnership when you get distributions. So now S Corp to C corporation and what we're going to call AAA. So this is another relatively complicated calculation. So doing the actual calculation is a little bit beyond the scope, but you can at least be aware that it needs to be done and what it is. So earnings in S Corp years are taxed regardless of the time of distribution. So if an S Corp has undistributed earnings and converts to a C Corp, the pre-conversion earnings need to be tracked in a special account called the Accumulated Adjustments Account, or AAA. And cash distributions from AAA are tax-free to the shareholders for 1 year following termination. So the idea here is you've left S corporation status, and this is really just the inverse of the E&P issue. If you leave S corporation status, basically if you blow your S election, or maybe you intentionally remove your S election, it depends on the circumstances. And that sometimes happens, actually. If you want to be publicly traded, in most instances, you have to be a C corporation. And so publicly traded C corporations are going to need to, if they're an S corporation, they're going to go public, then they're going to need to blow their S election or elect to become a C corp. So sometimes companies elect to do this, and that's actually not a negative thing because that tends to be helpful for them. So good. So this is, once again, just the inverse. It's not always a bad thing when you go to S Corp to C Corp, as I mentioned. This is just the inverse. You basically have this accumulated adjustments account. This is income that was earned in the S Corp that hasn't been distributed yet. And so that can be distributed for 1 year following the termination, and you won't be treated as a dividend. It'll be treated just as a regular distribution of capital that will reduce your basis. So there's that. So E&P, like I said, E&P and AA, the concepts and the calculations are very, very complicated. But at a conceptual level, it's easy to understand more or less what's going on here and why we have these transitional rules. And so those are just important things to keep in mind. And then we have S corporation distributions. We haven't really talked about this, mostly because it's similar to partnerships. But distributions from S corps are generally treated as from AAA, or return of capital to the extent thereof, and then as a distribution from accumulated earnings and profits, and then as a gain. So you've got these different S corp distributions, and there's different tiers in terms of what you eat away at. So shareholders may elect to distribute out of accumulated earnings and profits first if they want to, but this is the order in which things are distributions happen. And so the idea is AAA is basically your accumulated earnings within the S corp. And the theory is that, look, if you have accumulated earnings and profits when you go from a C corporation to an S corporation, then any income you receive, you earn, is going to be distributed first, because you're probably keeping those other earnings on hand just as a matter of keeping your company capitalized. And so we're going to take, when you have these different accounts, you have your AAA account, you have your AEP account, we're first going to take away from your AAA account. Those are the earnings that happened while you were an S corp. Then we're going to take for your accumulated earnings and profits account. Those are going to be treated as dividends. And then lastly, it's going to be treated as a gain. Oh, I'm sorry. I skipped one. You've got the AAA account, and then you've got a return of capital, then AAP, and then a gain. So return of capital, the idea there is it's like they're buying the shares back from you. So you're essentially, if you have basis in your shares and you get a distribution, then it's going to reduce your basis. So it's like a return of capital. So at any rate, that's a similar concept to getting a distribution out of AAA. It's basically the same idea. Because the AAA is actually going to increase your basis. So when you get earnings from the S corporation, those earnings are going to boost your basis. It's going to increase your basis. So that return of capital is going to reduce your basis. So once your AAA is gone, if you have basis in your shares, it's going to reduce that down to 0. Once that's 0, it's going to take accumulated earnings and profits, and then it's going to function as a gain after that. So distributions from S corporations can result in gains, but that's only if you're distributing beyond what your earnings are. So generally, you're not going to have gains out of that, but it can happen. So when might you get an instance where you have distributions in excess of the profits of the company? How could that happen? So if you have distributions of cash, but it didn't come from profits, where else can you get cash? What do you think? How does a business get cash before it has any? Let's say a business is starting up and they need to pay rent so that they can start to earn money. They don't have any cash. And it didn't come from the shareholders, because if it came from the shareholders, that would be basis. So besides shareholders, where else can you get cash as a business? There's another place. Where else would you go? Where do you go to get money? You'd go to a bank, right? So you could borrow it. So what we're talking about here, when you actually are getting gains out of an S corporation, that's typically from borrowed funds. Now, that's not the only way. Sometimes your basis doesn't match up, and there are other ways. But the general way is essentially that you've gone to a bank, you've borrowed money. So think about a business. You open on day one. You haven't earned anything, but you open up on day one, and you borrow $10,000 from a bank. And you say, look how much money we have. We've been doing awesome. Let's distribute that. And you distribute that immediately. Well, you put nothing into the business, and you just got $5,000 out of it. And it's not income. There's no income that flows through to you because you haven't earned anything. And maybe at the end of the year, you close the business, and now it just has $10,000 that it owes a bank. That's all the business did. Well, you never earned any income, so that never increased your basis. So you have a 0 basis. Can you go into the negative when you have 0 basis? And the answer is no. So things that would otherwise push you into the negative tend to result in gains. And that's why you end up getting taxed as a gain on it. Because you have gained. You just got $5,000 out of this business. You put nothing into it, and there was no income recognized on it. You didn't have to pay income tax on it. So there needs to be something paid on it, so it ends up being taxed as gain.